Hi, this is Richard Vague with the Tychos Group. Friday, March 10th, the Silicon Valley Bank of Santa Clara, California, a bank with 17 branches, $200 billion in total assets, $180 billion in total deposits, and $70 billion in loans, was closed by the California regulators, who then appointed the FDIC as a receiver. It's made the news. It was everywhere. Since it was a monoline bank focused exclusively on early stage venture capital community, it only had about a 40-45% loan to deposit ratio, a lot less than its peer group. It really had to invest the difference in bonds, billions of dollars worth of bonds. Now it did so, and it grew rapidly in 20 and 21, and it invested in bonds during that period. And since rates were low, it made the cardinal mistake of buying long-term bonds. And its bond portfolio available for sale was $21 billion. And it got crushed when rates rose starting in 22. By one analysis, its capital ratio, its Tier 1 capital ratio, which was 12%, if you had taken into account the unrealized loss on its bond portfolio, would have been 0%. So, which was a lot more than anybody else out there that, among the known banks. The regulatory community, the Fed, the FDIC, the Treasury, et al. Responded powerfully. And we've seen what they did. They extended credit. They guaranteed deposit and made them instantly available, et cetera, et cetera. It would have been hard to do more than they did. But it all it begs a few questions that I want to briefly visit. The first and foremost, could management have done anything to prevent this? And the answer, of course, is yes. There were a lot of things that management could have done, didn't do, and you can view management as fairly negligent, or at least, they missed that banking 101 class about liquidity and asset and liability management because they were severely, egregiously mismatched, and that was really the source of their problems. The second question that you could ask is the Federal Reserve to blame because of its interest rate increases? And the answer, of course, is yes and no. Banks should be prepared for adversity, and banks should have prepared for rate increases, even extreme rate increases, and most were. So in one sense, the Fed wasn't to blame, but the irony, of course, is the Fed is now rescuing something that was caused by its aggressive rate increases, and it has within its grasp the solution, not only from a regulatory standpoint, but just by easing off rates, and we'll get to see whether they do that or not. Third question is, why didn't the rating agencies and the regulators act sooner to prevent this? Certainly management was responsible, but you have to ask about those two entities. Well, rating agencies essentially aren't reformed since the GFC. They didn't act fast enough with appropriate rating changes then. They certainly didn't do that now, even though it was easy to ascertain for anyone who had access to the public financial information of SFVD that this was a major issue, and so it was really a lapse there. The regulatory community, we don't know what was going on there, what the dialogue was. You could argue they should have acted earlier, more assertively. But you would also note that the banking industry in 2018 went in and reversed a lot of the guardrails that Dodd-Frank had provided for smaller banks under $250 billion in assets, and that certainly was part of the equation here. Some of the stress testing that was mandated in Dodd-Frank had been relaxed for these banks, which is clearly ironic. The next question is, will uninsured depositors get all their money back? And of course the answer is yes. We now know it was certainly in doubt on Friday. Some banks were panicked that they would have to cease operating altogether, those that had too much money in SVP. But it really begs the question, why did folks not know not to keep over $250,000 in bank anyway? Didn't we learn that lesson in '08? Didn't we go to school and read about FDR and the FDIC in the 1930s? I've been astonished how many folks kind of don't know that, even in my conversations today, the Monday after all this happened. Next question is, will the troubles that brought down SVB bring down other institutions as well? The so-called contagion effect. Well, the regulatory community has inserted itself into the equation to make sure that either doesn't happen at all or happens on such a limited basis that there's no broad impact, with the regulatory actions that they have taken. It's quite remarkable. Of course, we have questions about moral hazard in this situation. I would argue that nobody ever learns the right lesson about risk. Whether regulators do this sort of thing, they don't. This was happening in the 1800s. This was happening well before FDIC was enacted. Banks misbehaved. Customers didn't pay attention. We certainly could have learned all of this in '08. We didn't. There's a lot of blame to go around, but I would say, people may learn these lessons for a very brief period of time, but then it all goes out the window. Will there be broader economic damage from the SVP failure? Well, I would argue that within the venture capital community, which was already chastened by the events of the last couple of years, where you saw an implosion of the tech, the innovation industry sector, and this is just going to make it more difficult for that sector. But and maybe there'll be a cautious tone broadly. But as a general matter, we don't have anywhere near the problems we had in '08. We have a few pockets of issues. We certainly have the real estate industry stressed, but there's nothing comparable to what we were facing in '07 and '08. And so, we may, I would keep my prediction from earlier, which is, we may have a mild recession. Maybe not, but we aren't going to see what we saw in '08, '09. One last question. This is obviously a very cursory review of all this, but one last question that I think we need to step back and ask is that, given the lessons of the GFC and the pandemic, weren't we all supposed to be more attuned to risk, more cognizant of risk management? And if so, how did we get immediately drawn into a massive tech boom and collapse and missing the fallout and failure it was bringing to one of its central resources, the Silicon Valley Bank? The truth is, the lessons of risk are ones we will never fully learn, it seems. And in those brief moments when we seem to, we instead forget all too suddenly. So at any rate, as other major developments occur, we'll certainly comment on those, but that's our comment for today. Thanks.